So just when you think we're done with taxes, we got another tax we're going to layer on here. So 2025 tax planning, investment income, the 3.8% surtax. So I want you to understand, and when it comes to investment income, if you meet the thresholds, which are pretty high, but once you meet the threshold, you get an extra 3.8% tax added to the taxes that are here on the right side of the board that we've gone through in several shows. So I want to put it to Tom, and I want Tom to tell us, why are we talking about this net investment income tax?
Yeah, I mean, we're doing this video because no one likes paying taxes, especially ones that are surprise or kind of hidden. And I can tell you that a lot of people are paying this tax and they have no idea about it. And if they did, they'd probably be mad about it. And so we just want to tell you what it is, how it works, and what's subject to it and what's not. And so let me bring up the show notes here. You can find these below our video. They're also on our website at cardinalguide.com. As always, we got the board. We'll get back into here and give you some more details about this. We have two charts, and again, I have these charts sitting on my desk. I reference them every day. This blue one really talks more about what the net investment income tax is, what's subject to it, what's not, how do we get there. We'll talk more about this as we go through the show. And then this one, I use this all the time. This really lays out a lot of the key brackets for ordinary taxes. It lays out capital gains tax brackets. I mean, again, there's a lot of really helpful information on this. So if you watch this video and you want some more information and really get into the details about more of what we're going to talk about, you can find these at the charts in the show notes here. So I'll turn it back to Hans and we'll get going here.
Okay, so this net investment income tax, and the acronym is NIIT. That we try not to use too many acronyms on the show. Um, and it started at January 1st, 2013, and it was used to do some of the financing or all of the financing for the Affordable Care Act, the health insurance bill, and it's been in place. The thresholds to pay the net investment income tax are pretty high. I mean, they're $250,000 for married filing jointly, $200,000 for single, and for estates and trusts, it's actually pretty low. It's $15,650, and in 2025. Now, interesting to note is these two thresholds, the married joint and the single, have never been indexed for inflation. So this tax is 12 years old, or we're paying in the 13th year of it, and there's no indexing for this. And this is your adjusted gross income, and it is only charged on certain types of income. So let's get clear about that. And Tom's going to give you some examples a little bit later in the show. But the investment income tax is only charged on like interest that you get on a CD or a money market account, just regular interest that is taxed at ordinary rates, which people that are in the highest brackets, it's up as high as 35 and 37%. This 3.8 gets added to that for interest, dividends, capital gains, long and short, taxable annuity income, which excludes IRAs. So if you have an annuity in an IRA, you're not going to be paying this 3.8%. Royalty income, passive rental income. So it's pretty much interest, dividends, and capital gains where this becomes a factor. And for high net worth people with pretty large income, and they have a lot of investments that are not held inside of an IRA, this tax is very relevant. Now let's talk about what is not investment income. And so you got a pretty nice list here, and you say, aha, I'm good, I'm safe. Well, this stuff you don't have to pay the 3.8% on it, but it counts toward meeting the threshold. And Tom's going to give you some examples of that, or an example. So what's not investment income is wages, your W-2 income if you're working, self-employment income if you work for yourself, active trade or business, where you're actually participating in the distributions from IRAs. So let's be clear on that, as a lot of folks, their interest earnings and gains on stock and dividends, a lot of times they're held inside of an IRA. And as long as they're in the IRA, and when you make a distribution, you're not paying the 3.8%. But just keep in mind, it keeps you meeting the threshold. Roth IRAs don't count for this. They don't have any taxes. Company plans, excluded gain from the sale of a principal residence. So where you get that 250,000 a person or 500,000 for a couple are able to exclude the gains on the sale of their personal residence. That 250 or $500,000 exclusion, you're not going to have to pay the 3.8% on that. But if you sell your house for way more than that, you're going to have to pay the 3.8% on the amount above the exclusion. Municipal bond interest, proceeds from life insurance, Social Security and veterans benefits, and gains on the sale of an active interest in a partnership or S corporation. So, we listed here what is investment income, what's not investment income, but all of this stuff creates the income tax over here. And we got the chart on that, which we've gone over in several videos. So you're only going to pay the tax on what is investment income, but all of it counts towards meeting these thresholds. And so I want to put it to Tom, and Tom is going to talk about just showing you how this thing actually works.
Yeah, I mean, I think Hans made a very good point here is that all income goes to determine if you have to pay this tax, but not all income is subject to this tax. So let me run you through just a very common example that we might have someone coming in as we're doing a plan for them. Is maybe they've started Social Security, they have maybe a pension or an annuity or something like that. Or let's use the IRA annuity. We'll exclude the non-qualified annuity for this example. And then they're doing Roth conversions, right? And so all of those numbers, let's say they're converting up to the 24% tax bracket. That's just under 400 grand for a couple. And then about 200 grand or so, just under that for a single filer. And so they're doing conversions up to those thresholds, and that pushes them, for the couple, certainly pushes them above the 250,000 threshold for this net investment income tax. But all those things I've just said, IRA distributions, Social Security amounts, pensions, none of those are actually subject to this 3.8%. And so they're actually fine, right? This is not impacting them. But then they maybe have a second property, they have other stock in a taxable account that they want to sell for whatever reason. And they're looking at the capital gains rate and say, oh, depending on the brackets, and let's say they're staying within the 15% capital gains rate, they say, oh, I only have to pay 15% on that. But now that 100,000 of capital gains that they have from either the sale of a property or a stock or something like that is actually, that income is subject to the net investment income tax. So in reality, they're paying 18.8%, 3.8 plus 15, 18.8% on that capital gains when they're looking at these brackets and they say, no, I should only be paying 15%. And so that's just an example of how all income goes to determine whether you exceed that threshold. But again, not all income is subject to that. So it's important to understand that distinction because it really it makes a difference. And so if you don't have any net investment income tax, you don't have to worry about this. If you have a lot of investment income tax or net investment income, then this tax really becomes really relevant, and it does increase the amount of taxes that you're paying. And so I think it's important to know how that works, how they're related, how doing things like Roth conversions can put you above these thresholds. But again, the amount that you're converting isn't subject to that tax.
Yeah. So this is, it's just some notes that I want to make is no inflation adjustment as we stand right now. And this is putting 3.8% on top of these other tax rates, whether they're capital gains or ordinary tax rates. And it's only applied to what is investment income. And there's a whole list here of exclusions. So for a lot of you folks, you don't really have to worry about this. But when you go to start selling something, that you've had for a long time, like a beach house, or you had some investment property, or you have some land that you have a very low basis in, and then you're going to sell it for a large amount, um, that capital gain is not only going to be subject to these capital gains taxes, but there's going to be 3.8% added. So just want to go over this in the scheme of things. It gives us another opportunity to talk to you about the tax brackets. And we're thinking about this in our practice, not what happened last year. We're thinking about this into the future. Yeah, it just amazes me how many people that are paying this tax, high net worth people, high income people, and they don't even, well, they maybe know about it, but they don't really understand it and how it works. And it just kind of gets, they just file their taxes every year and somebody does that for them and they don't really have an understanding. And we point that out to them when they come into our financial plan. We can just go right to their tax return and pull this thing out. So we want to go over in terms of comprehensive financial planning. How does this apply? And, we talked a little bit about Social Security today, and we talked also about 401k and IRA money, because that's excluded from the net investment income tax. We talked a little bit about income, because that's what people are doing in retirement, and this is their money that they're living off of. And if you have a person in a very high tax bracket, and then they have a lot of interest income, capital gains, dividends that they're living off of, this is just adding 3.8% to what is already a tax rate in the 30s. Estate planning, we haven't covered that much, and obviously the whole video is about taxes. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.